Hello, ladies and gentlemen. My name is George Kingori, your online finance guy who speaks about all things finance, how you can be able to save, invest, and grow in your financial affairs. And today I'm going to speak about 5 ways people make money from real estate in Africa and in Kenya. So the first one is pretty simple, and many people actually know it, and that is buy land, subdivide, and sell the subdivided portions to people at a higher than proportionate price from what you bought. So if you bought a piece of land for 5 million, you divided it into 5 pieces, you sell it at more than 1 million to be able to make the difference as profit. And that is pretty simple and straightforward, and it's actually one of the easiest way to be able to enter into real estate. Of course, there are people who have entered into it by getting land, acquiring land without actually purchasing the land, and getting into an agreement by the owner of the land to sell the land first to others so that they could be able to get the money and pay them at a later date. Sometimes this can be a bit tricky, where the person is shifty and can get the money from the people who are the third party people who are going to buy the land, and not remit the same to the actual owner of the land. So sometimes this can be tricky. So when you are buying subdivided land, of course it's important to know who is the real owner of this business. But by and large, that is how people subdivide pieces of land, sell at a smaller premium than what is the actual value of the subdivision, and get a premium from that. And that is simple and straightforward. Then the next one is buying land and adding value to this piece of land and selling the land at a premium. You could buy land, subdivide the piece of land, then be able to create access road, maybe maram roads, maybe roads that have concrete or tarmac. You could do a borehole, you could bring electricity on the site, you could plant trees, basically adding something that will be able to increase the value in the eyes of the people who are actually going to buy this land. So adding value to the piece of land. Again, this is a bit of a higher level than the first method that I showed you of buying and just subdividing and selling as is. This you add some value, and if your addition of value creates more value in the eyes of the buyer beyond what it has actually cost you, you earn a little bit better. So you can say this is buying and subdividing and selling 2.0. Then the third one is buying land, holding it, and selling it at a later date. Yes, you buy land maybe a year, then you sell it in the third year, and then you sell it at a premium. Of course, you have to be very deliberate and ensure that you sell the land at the actual real value. That means that you have equated for inflation over that period of time. You should have a return on investment figure that you have in your mind, and be able to add in the inflation rate so that the value that you receive at the end of the day has been catered for the inflation. For example, if you desire 10% return on investment on any piece of land that you hold and sell, and you sell after 30 years, so you buy a piece of land for 1 million shillings, so $10,000, then you want to sell this land at you want at least 10% per annum. So meaning that the value that it should be able to increase is 1 million times 10%, which is 1,100,000 by the end of the first year. And that is okay. Now here is the thing. You should now equate the value of inflation plus the rate that you want. So if you want 10%, add say another 5% if the prevailing rate of inflation is 5%, so that it is now 15%. So that now you charge 15% plus the value that you bought the land, so that you can be able to get your 10% and you do not feel the pressure of inflation. Many people do not actually do this, and they just look at a return on investment, do not equate for inflation, and they end up making much less in value than they think that it is worth. So, and that is on a basic minimum. So if you want 10% and you want to hold it for a year, but the inflation rate is 5%, then you add 15%. So now you sell the land at 1,150,000, then the 50,000 caters for the loss in value because of inflation, and you get your 100,000 that has been converted in real terms without inflation. That is how you buy, hold, and sell at a later date. Of course, you don't need to do it strategic. The more strategically you do it, the better it is financially for you. So buy land that has some strategic future value. Maybe there's a road that is going to pass there. Maybe you buy in the outskirts of the city, and where the city seems to be expanding to is where your piece of land is, so that you become part of the outer reaches of your city, and the values rise because more and more people are building in the surrounding areas. Or maybe you buy a piece of land next to an institution that needs accommodation in the future, something that shows there is going to be value in the future, and that is how you are able to hold and sell profitably in Kenya and Africa and be able to do it comfortably. Of course, you have to be willing and to have the financial discipline to wait. This, unlike the others, may have you wait a little bit longer to be able to realize the values. Again, on selling these pieces of land, do not sell when you are desperate. When you are in a fix, distress sale, make much less money for the people because you are in need and you are desperate. And I can tell you that buyers smell the desperation that you have when you are selling a piece of land. Brokers smell your desperation and will offer you much less value than you should be able to get. So when you are holding and selling, sell when the seller comes, equate your value then, and be willing to wait as much as you can, and you'll be able to get good value for your land. Then the fourth way of making money is to buy land, construct houses on this piece of land, and sell these houses for cash. So meaning that you have to get the money to be able to buy the land and have to get financing, especially when you are beginning, because you do not have a name. People do not know you. They're not willing to buy off plan. If they buy, even better, because now they have self-financed the construction. But if they don't, you need to have cash. And this is where the rubber hits the road for most real estate people. They have these big projects. They need to do these projects, but they don't have a name. And institutions will not give you money if you have no previous record, especially if you are young and you are inexperienced in the field. They usually offer funding for companies that have established record, have some assets elsewhere that can be able to attach not just the value of the land, and they trust your name because you can be able to sell these houses and turn around the houses into cash at a short period of time. So if you're not that experienced, you need to finance and have the money on your own. Get funding elsewhere, look for funding from friends, get angel investors or whatever as you start, but you build the house and sell the house for cash to sellers. Of course, the buyers can take loans elsewhere on their own and bring money for you, and they can be able to buy the property. Of course, you need to price the house in such a way that it caters for all the costs. One, the construction costs, the cost of acquiring the land, the permitting processes, inflation, any cost of capital. Say if you took a loan to be able to finance this construction, these interest rates should be factored in the sale of this land. Then additional costs that are involved while you are selling the land. Maybe there are some things that you needed to pay off, some stamp duty, some other things that you needed to pay off. Cater them there in the cost of the buying of the land. Sometimes it becomes tricky when you are trying to get into this level of making money through real estate. It becomes tricky if you have a lot of leveraged capital, a lot of capital that is being paid for the next month after you have taken the loan. So if a house is going to take, for example, 6 months to construct from start to finish, assuming there are not going to be any challenges as regards to weather, supply of raw materials, and whatever other factors. So if you take a loan and have to pay interest the following month, but the house has not been completed yet, up to the 6th month, you are paying tax for the 2nd month, the 3rd month, the 5th month, the 6th month, and you are not assured that you will sell the house on the 6th month. So if again the time that you sell the house is 6 months later, and especially in an economic crisis, it becomes more difficult to sell a house. So if you're going to sell the house after a year after you have taken the loan on that house to construct, meaning that you will have to pay 11 months of interest on this house. So again, this is where the rubber meets the roads, because you can also not sell a very high price, because again, sellers or buyers equate the value of what you are selling in their eyes, and if it is correct, then the market cannot be able to accept your price. If it is too high, they might not be able to accept your price. And first-time investors in this level of investment do not actually make money. This is because of all the interest rate charges and all the cost of financing factored into this construction, and because they're also not as knowledgeable on selling, they end up paying a lot more than they actually make. Sometimes they break even, but sometimes they don't. So they end up wasting a lot of time, wasting a lot of money, and they end up having a lot of issues. And this is where, if you break through this level of construction and investment in real estate, you could be able to make millions. However, there is also a fifth tier on the ways they can be able to invest, and this is where the real money is. This is where people become filthy rich, and that is buy land, construct houses, and offer financing to the people who are going to be owners of this house. So what you do normally is you have the cash, you have the capital, you build the house, you finish construction of the house, then you offer these houses to the market at a certain cash price. So maybe the cash price is, say, 5 million. So if somebody has cash, they bring their 5 million, they get their house, and that's done and dusted. However, you offer a component financing component. This is where you tell them, for this 5 million house that you're going to get, you pay 1 million, for example, 20% of the value as down payment, and you pay the rest in installments that you are comfortable paying for a period of time. And you say an interest rate of, say, 12%, which is fairly average in an African country, and in Kenya in this case, sometimes as high as 16%. But this is where you make your money, because you have offered somebody a loan of 4 million to be able to pay for this house, and you have offered flexible financing methods. And this is where the rubber meets the road, because when people pay down the capital, they're still paying down the interest. So you, as a real estate investor, start making money like a bank. Yes, you start making money like a bank. And unlike a bank that may offer unsecured loan, you are offering a loan with the asset in your possession. This is where filthy rich people make money. No risk. All the risk is in the buyer, and you have a contract, and if they are unable to pay you, kick them out, and the value of your house is going up because the value of the land is going up, the value of the houses and the construction costs are going up. So your value is going up. If they're unable to pay, you still make your money, and they lose the money that they have been paying you, and you're starting to make money out of interest rate that you are charging these individuals. It can be a good thing if they're able to pay down quickly, either in cash or pay down quickly and pay much less in interest. It is also good because you are providing them a home that can be able to pay at a flexible terms, which may not be available to many people. And it is also good to you as an investor because your underlying asset is still in your possession. You still have the title deed and the documents in your possession because you have not transferred the title of the house because they have not finished paying off the loan. This is where the money is made, because a 5 million house can, in 10 years of interest rate payment, be actually the double the value. So this person may pay 10 million plus for a 5 million house, and you have made your money. This is where it gets interesting. If you are charging them a down payment of 2 million or 1 million, if, say, you give them a down payment of 40%, and you've equated your actual cost of construction to around that value, then you end up just making profits from the capital they'll be paying you and the additional exponential money from the interest they're paying you. That is where the money is. I hope that you are learning, you are growing, and you're becoming better in your financial affairs. Remember to subscribe to the channel, to leave a like in the comment section, and to tell me the videos you desire for me to continue to speak about. Thank you, and enjoy your day.